Hello and welcome to a new episode of Meet Is Capital. My name is Jacob Grapengiesser, I'm the CEO of Is Capital, and together with me we have David Nicholls, who's a PM for our emerging markets strategy. Today we would like to share some perspective of what has happened during a pretty rocky ride in the second quarter. So David, why don't you start and tell us what happened or what we have seen on the markets?
Sure, yeah. So Q2 was an exceptionally strong quarter, actually, for both emerging and frontier markets, which returned 12% and 11.6% respectively. And if you look at that, the emerging markets again outperforming the S&P, so which only returned around 11% as well. And if we look at the start of the year, I think it's been even more dramatic, right? And if we look at this first slide one, you can see that it's been a really exceptional year if you're a US dollar investor. With emerging markets up around 17%, outperforming the S&P by 10%. Frontier markets actually doing even better than that. So which is really striking, of course, given the huge barrage of negative headlines we've had in terms of geopolitics, trade, politics, and issues like that. And I think the way to really understand these actually is to look at this exact same chart, but in euros. And you can see here that if you remember that emerging markets had 17% return in dollars, in euro it's only 2%. So I think it really speaks to something we've been saying for a while, that the currency is a massive driver of overall returns. And it's really difficult to overstate how important currency is and will remain going forward for both emerging and frontier markets. And this is really something I think we'll come back to. But Jacob, yeah, of course, the main story throughout the quarter and really the year has been Trump's tariff wars. So can you tell us what we've seen there?
Sure. Everything kicked off with a Liberation Day on April the 2nd. Trump increased tariffs very drastically. I think this came as a surprise to most market participants. Tariffs on China even went as high as 135%. Luckily, the invincible hand of the market disciplined Trump, right? I think especially the bond yields and the bond auctions in the US, they sent a message to Trump that you need to stop this. You need to be less aggressive. He made this 90-day pause in the tariffs, right? We haven't seen many of the very large deals as China coming through, but we have seen, for example, a trade with Vietnam and the UK coming through, luckily. So I think all in all, we're going to have a new world with higher tariffs that is going to eat into global growth, but it's a much more benign scenario, of course, than what we were thinking about 2-3 months ago. But David, why don't you tell us a bit more what's happening on some of the specific markets?
Yeah, I mean, if you look at absolute returns for emerging markets, the main drivers are very much Taiwan and Korea. Taiwan returning 26%, Korea returning 33% in US dollars. And Taiwan, I think, was the most interesting. The Taiwanese dollar appreciated 14% versus the dollar. Some rumors that the government was actually intervening in order to help their trade negotiations, but also foreign investors piling into local shares, exporters reducing US dollar holdings and things like that. So, I mean, that's obviously really significant for returns. I think it's worth highlighting, though, that the large exporters do hedge a lot of their currency exposure. So it's not the impact that you would worry about for someone like TSMC. It's not as material as you think. And in fact, TSMC's results were really stellar, with April 2025 revenue going 48% year on year, partly due to this pre-buying before the tariffs were implemented. I think the Korean market was another really fascinating market. What we had in the quarter, and I guess was anticipated ahead of time, was a really business-friendly, stock market-friendly government that actually have explicit stock market targets as part of their election campaign. And the nice thing is that Korea is actually quite easy to improve because and drive returns, because a lot of the companies are very badly managed in terms of capital allocation and transparency. And so when that starts to turn around, you can see really increases in value of these companies, which is why the Korean index has had its strongest start to the year in 26 years. But Jacob, how about frontier markets?
Yeah, so frontier markets also did well. maybe even surprisingly well during the quarter. For example, the UE was up 12%. We actually had a bet internally inside the firm, which country, which stocks are going to be the best performers this year. And my bet was Nigerian banks, and so far I'm leading this little competition. Nigerian banks added 30% during the quarter, but they still trade at only 2.5 times earnings. So there's still room for further reevaluation. But another part that did really, really well was emerging Europe. David, can you tell us more about this?
Yeah, sure. I mean, I think we have to highlight it. And so, yeah, our Balkan fund returning 20% in the quarter, New Europe fund returning 17%. Year to date, it's even more impressive, 31, 36%. And if you look at why it is, I mean, yes, it's robust stock picking, but really the incredibly strong performance of countries like Poland and Greece. And if you think about these countries, they're really in the sweet spot, because there's global investors are looking for large, high quality liquid markets. So Europe stands out, but they also want growth. And obviously in most of Western Europe, there is really no growth, but actually Greece, Poland, you very much do get that. And I think there's some global investors starting to wake up to that fact. I think what's even more remarkable is these markets are still not expensive. You compare those to Western Europe, around sort of 9 times PE. Despite, if you look at the two funds, they've returned 165% and 147% in US dollars over just the last 3 years. But Jacob, yeah, in the quarter we published a piece on emerging markets, the return of emerging markets. Can you start by sort of setting the scene like we did in the piece? What's different for emerging markets nowadays?
Well, setting the scene, it's all about emerging markets have significantly underperformed in the past 10 years, right? So here we can see the 10-year performance, clearly US leading the way, up 246%, Europe up 85%, and emerging markets up only 59%. So, close to 200 percentage points underperformance, right? I guess the obvious question is like, why should you invest into emerging markets? But as David showed in the beginning, emerging markets have started to outperform. And I think that the trend is broken. I think that other markets will start to outperform the US because investors are looking to diversify away from the dollar. This will be initially in small steps. You might first buy Europe and then later emerging markets. But what we look at is the PEG ratio, or simply the growth rate you get at what valuation. It's very, very simple at the end of the day, right? So we do know that the growth for American companies or US companies is quite high, right? 9% earnings growth for this year, 14% for next. So if you take the average of these two and you compare it to the PE ratio, or you divide it by the PE ratio, you get the PEG ratio, right? So for the US, you have a PEG ratio of 2. So effectively, you pay a PE ratio that is twice the growth rate, right? Anything close to 1 is very attractive. In Europe, you have much lower growth, 3% this year and 10% next year. So if you divide that with the PE ratio, then you get 2.4. So yes, Europe is cheaper, but it's growing at a lower pace. So in relative terms, Europe is actually less attractive than the US. For emerging markets, it's a PEG ratio of 1.1. So that is double as attractive as developed market if you want to simplify things. You can see here that it's 11.6% growth for this year, 12.6 for next year, and that's with the PE ratio of 13. However, looking at our fund, it's a 0.8 PEG ratio. So our fund is 30% more attractive than the emerging markets index. And if you look on our frontier market fund, well, it's a PEG ratio of 0.6, so it's even more attractive. Frontier markets might have other liquidity risks, etc. But if you look from a pure fundamental perspective, the frontier markets are the most attractive asset class. Again, my Nigerian banks, right? Another, I think, interesting observation is that most investors are looking for long-term growth. And I mean, the starting point in many cases, it's just how the country is developing. If GDP is growing, typically companies are growing, right? I mean, it's quite simple. So if we look since the beginning of 2019, so when the pandemic started, right? So before COVID, the Indian economy has grown by 37%, China by 32%, developed markets only by 10%, and for example, the German economy has been flat for those 5 years. So I think this is quite remarkable. If you take it on 1 year, maybe it's 2% versus 5% or 7%, you don't really feel the difference. But if you extrapolate this over a longer period, then you see this huge difference in terms of growth. But of course, this will continue, right? So for the next 5 years, emerging markets are expected to grow on average 4% per year versus 1.7% per year for developed markets. But David, a very important factor in this is the dollar, or rather a weak dollar. What can you tell us about that?
Yeah, sure. I think dollar weakness is historically very, very associated with EM and FM performance. And you can very much see that if you look at this slide 7. We basically have the inverted trade-weighted dollar, the DXY, and just the emerging markets performance, so not adjusted by anything. You can see the very strong correlation. I think what is sort of less discussed is why exactly that is, and there's of course a number of reasons, even excluding the obvious translation effect, which is that if you earn local currency, of course, and the dollar weakens, you get a higher return in dollars. But the number one thing is kind of, as Jacob, you alluded to, this sort of psychological effect. And for example, I spent a full week in Germany last week talking to a range of investors, and the one consistent theme that came up was not so much sort of US tech valuations or capex intensity or anything like that. It's very much their US dollar revenue exposure, and really, really concerned that they're just hugely sort of overweight this currency that potentially has significant downsides. And so as a result, almost all of the investors I spoke to were really questioning their emerging and frontier markets allocations. So I think when you start to see that, we're really at the early stages of that so far. We've only had sort of 6 months or something of US dollar weakness, but of course that can carry on, as this sort of slide shows. The second part, I think, which is a bit more overrated, I would say, is this idea that emerging and frontier markets have a lot of US dollar debt that gets cheaper. Not really the case anymore, I think, but particularly due to all the crises. Outside of the exporters that anyway have dollar revenues. And then the third one that I think really does come up in all the company conversations we're having is that when you have weakening dollar, you have falling input costs, which means higher margins for the companies we invest into, but also falling inflation, which particularly the case when you combine it with the falling oil price. You see what OPEC are doing in terms of constantly increasing production. And so, for example, in India, we're going to get 100 basis points of rate cuts this year, which obviously has a very positive effect for economic growth and things like that. So that's, I think, the sort of fundamental driver that we're really seeing now. And rate cuts are much higher than we expected at the start of the year. But yeah, Jacob, in the piece, we also acknowledge that emerging markets can't really perform without China. And of course, you're based there. And we see these sort of somewhat conflicting narratives of this trade war, tech dominance, and of course, sort of questions about the economy. I think we've already addressed the trade wars quite in detail. But what are you thinking about those other two drivers?
Yeah, so I think the problem the West will have is that a lot of the innovation now is happening in China. If you look on EVs, BYD is selling more EVs in Europe now than Tesla is. If you look on humanoid robots, clearly China will be the leader in this. Here on the short video, you can see a Chinese guy fishing and outsourcing, walking around with his child in the baby stroller to a humanoid robot, right? So I think if you want to invest into the future, like it or not, there is a lot of the Asian, especially Chinese tech companies and manufacturing companies that would be really leading in this process. All right, but with that, David, what can we expect going forward?
Yeah, sure. I mean, I think we've kind of summed up the investment case in a nutshell, right? I think after sort of 15 years of underperformance compared to developed markets, particularly the US, you've now got a background where there's huge policy uncertainty in the US. There's real questions about the dollar, and that's creating clearly a much more positive background for emerging and frontier markets. We've seen that play out this year. Emerging markets outperforming the S&P by 10%, but clearly there's potentially much more to go, right? I think the main point we had on this sort of structural story is the economic growth, but then combined with this sort of really underappreciated innovation boom, particularly in China, that's really driving a lot of the world's sort of cutting edge technologies. So yeah, I think so far positioning remains light. Investors are very much just doing their homework. So it definitely feels like quite an exciting time, I think, for the asset class. But with that, yeah, I'd like to thank everyone, wish everyone a happy and restful summer, and yeah, looking forward to seeing everyone in autumn.